Welcome to the deep dive. Looks like we've got quite the ambitious stack to tackle this time, all about cracking the code of trading success.
Oh, yeah.
And what better guide could we have than Jack D. Schwager's The Little Book of Market Wizards?
You know, Schwager's a bit of a legend in the finance world, right? I mean, he's interviewed like some of the most successful traders out there across all these different markets, real titans of the industry. And in this book, he basically distills all their wisdom into, well, actionable insights.
So basically, think of this deep dive as our attempt to kind of like decode the minds of these market wizards, right?
Yeah.
What sets them apart? Is there some magic formula for success? Do they have like a crystal ball or something?
I mean, if you're looking for like a get-rich-quick scheme or, a guaranteed path to riches, you might be a little disappointed.
Okay, fair enough.
But what Schwager does is he reveals something far more valuable. I think it's the underlying principles, the mindsets, and honestly, sometimes even the surprising habits that drive these traders to success.
Okay, I'm intrigued. Let's unpack some of these secrets. Maybe start with a little reality check. I think a lot of people assume that there's like one right way to trade.
Yeah.
Some secret formula that guarantees wins. What's Schwager's take on that?
He tackles that myth head on right away. He does this really interesting thing where he contrasts two legendary traders, Jim Rogers, who's a fundamental analyst who, get this, doesn't even look at charts.
Yeah.
And then Marty Schwartz, who was a master of technical analysis and achieved incredible, consistent returns.
Wait, so they both had completely opposite approaches.
Yeah. And both were wildly successful.
Those are different strokes for different folks, kind of thing.
Exactly. There's no single, right methodology, Rogers, he believed in really understanding the fundamentals of a market. But Schwartz, he saw patterns in price movements as, the key. Mm-hmm. It's really all about finding an approach that resonates with you, your personality, strengths, even your risk tolerance.
That makes a lot of sense. There's no one right way to be a musician. Some folks are drawn to classical, others to jazz. You find what fits your style.
Exactly.
But speaking of different styles, this next point in the book is something I found super intriguing. The market wizards are all about hard work, dedication.
Right.
But they also talk about trading effortlessly. How does that even work?
It is a bit of a paradox, isn't it?
Yeah.
They're known for this, relentless work ethic. Guys like David Shaw, right? Not only did he build this, quantitative trading powerhouse, but he was also involved in all these other companies, scientific research, even presidential committees.
Wait, hold on. How do you even find time to trade when you're running, a multi-billion-dollar company, A&D, solving complex scientific problems?
Right.
That's barely humanly possible.
That's what highlights this crucial point. The real hard work in trading, it happens before you even place a trade. It's about the research, the strategy development, back testing, constantly refining your edge.
So like an athlete who spends hours and hours training so that in the heat of the game, their movements are just, instinctive and fluid.
Exactly.
So the key takeaway here is to front load that effort.
Yeah.
If you've done your homework, if your strategy is solid,
right,
the actual act of trading should almost feel effortless.
Right. It's like second nature at that point.
But let's face it, trading is high stakes.
Yeah.
I mean, millions, sometimes billions of dollars on the line, right? How do these wizards handle the pressure? How do they stay so disciplined when their emotions are just, screaming at them?
That's where the mental game comes in. Schwager really hits on this point over and over again. He really stresses that discipline is paramount, even more so than picking the perfect entry or exit point. He shares this anecdote about Randy McKay. He built a fortune from a tiny trading stake, right?
Yeah.
But even HEE had moments of weakness.
Okay, spill the tea. What happened?
So picture this, right? McKay is rushing to catch a flight when he sees a quote for the British pound, and it seems way off. And he just assumes it's a bad quote, doesn't even bother to verify. He figures he'll deal with it later.
Oh.
Turns out it wasn't a bad quote at all. It was real. And by the time he realized his mistake, he had lost millions.
Oh, that's gotta hurt.
Right. And it's such a powerful lesson about sticking to your rules.
Yeah.
Even when you're under pressure.
Even when you're about to miss your flight.
Exactly. Because the market, it doesn't care about your excuses. And this kind of leads to another fascinating aspect of the market wizard's psychology. Their confidence. Schwager points out that these traders often keep a huge chunk of their own wealth in their funds.
Wow, that's serious skin in the game.
Right.
They must really believe in their own abilities.
It speaks volumes about their conviction, But it does raise a really interesting question. Are they successful because they're confident, or are they confident because they're successful?
It's probably a bit of both, isn't it? I mean, success definitely breeds confidence, but I think you also need a certain level of self-belief to take risks, put your own money on the line in the first place.
Yeah, you need that foundation to build upon.
Exactly. And that confidence, I think, is tied to another crucial principle that Schwager keeps coming back to, risk management. In fact, there's a whole section in the book dedicated to, like, protecting your capital.
Oh, absolutely.
Now, risk management, let's be honest, isn't the sexiest part of trading, but it's arguably the most important.
I'd agree with that.
What are some of the key takeaways from Schwager's interviews on this topic?
There are some real gems in there. Paul Tudor Jones, he famously said, don't focus on making money, focus on protecting what you have. Then you've got Marty Schwartz with his idea of the uncle point, knowing your pain threshold, that point where you just admit defeat and get out of a trade before it blows you up.
I like that. Uncle point.
And then there's Bruce Kovner's rule. He said, know where you're getting out before you get in.
So having a clear exit strategy, like taking the emotion out of it when things get heated.
Exactly. It's all about having a plan and sticking to it.
I like that.
And then, you can't forget about Larry Height's 1% rule. Never risk more than 1% of your total equity on a single trade. Simple, but super powerful. Keeps one bad trade from wiping you out.
So we've got discipline, confidence, risk management. It's starting to feel like we're building a pretty solid foundation here for trading success. What else do these market wizards emphasize?
Well, one of the recurring themes in Schwager's book is the importance of adaptability. You see, the market's a constantly evolving beast, right?
Yeah.
And if you're not willing to change with it, you're going to get left behind.
It's like surfing, right? You have to constantly adjust to the waves or you'll wipe out. So how do these traders stay ahead of the curve?
They're constantly analyzing the results, figuring out what's working, what's not, and adjusting their strategies as needed. Schwager gives this great example. Edward Thorpe, a legendary quant trader.
What's so special about Thorpe?
Well, he was a pioneer in statistical arbitrage, right? But even he had to constantly adapt as the market conditions changed. His early system was market neutral, but then he noticed certain sectors were performing differently, so he went sector neutral. Then he realized sectors weren't even specific enough, so he shifted to factor neutral portfolios, basically neutralizing risk based on very specific mathematical factors.
Oh, talk about a commitment to staying ahead of the game.
Right?
Always evolving, always testing, always refining. It sounds like a ton of work.
Yeah.
But I guess that's the price of success in the markets, right?
Absolutely. And speaking of market dynamics, Schwager dives into this really intriguing concept, what he calls reading the market's whispers.
Whispers. Sounds kind of spooky. Are we talking about like some secret market language we need to learn?
It's more about understanding that the market often reacts in unexpected ways, especially to news events.
So like we shouldn't always trust our gut reaction to big news.
Right, because the market often anticipates news and discounts it in advance. So a seemingly counterintuitive response can actually be a very valuable signal. Schwager tells this great story about Ray Dalio witnessing two major events: Nixon taking the U.S. off the gold standard, and later Mexico defaulting on its debt.
Both sound like pretty bad news for the markets.
Yeah, you'd think so, right?
Yeah.
Dalio expected the markets to tank, but in both cases they rallied.
Wait, what? So his gut instinct was completely wrong. What was happening there?
See, it's not about being right or wrong. It's about understanding how the market perceives events. In both those cases, the market had already factored in the bad news, right? And the rallies were driven by other forces that hadn't been fully anticipated, like, say, central bank intervention. So you got to look beyond the surface, beyond the headlines. What's the price action telling you? That's where the real insights are.
Okay, so it's like the market's playing 4D chess while most of us are stuck playing checkers.
Exactly. You got to up your game.
I like that. Let's take a quick break, and then we'll delve into even more of these fascinating market whispers, along with some truly surprising insights from the world's top traders.
Sounds good.
I'm ready to dive back in. This is already changing the way I think about the markets.
That's what we like to hear. Welcome back to the Deep Dive. Before the break, we were talking about how the market often reacts in, unexpected ways, and how important it is to kind of read between the lines.
Yeah, those market whispers.
Exactly.
Give me another example of how this plays out in the real world.
Okay, so Schwager shares this interesting observation from Marty Schwartz, a trader known for his incredible consistency. Schwartz noticed that when the market gets good news and goes down, it means the market is very weak. When it gets bad news and goes up, it means the market is healthy.
Interesting. So it's not just about the news itself, it's about like how the market digests that news.
Right.
A counterintuitive reaction can actually reveal a lot about the underlying sentiment.
Exactly. Take the 1982 Mexican debt default, for example. This was seen as a major, negative event, and yet the stock market rallied.
Wait, that seems completely backwards. Why would the market go up on bad news?
Because it had already anticipated the default. The market often kind of prices in events before they actually happen, so the rally was actually driven by, other factors like maybe central bank intervention that hadn't been fully anticipated.
Okay, so it's like the market's playing 4D chess while most of us are stuck, playing checkers.
That's a great analogy. Schwager also tells a fascinating story about Michael Marcus, a trader who was heavily long soybeans. This super bullish report comes out, and everyone expects the market to, skyrocket.
Sounds like a sure thing. What happened?
So the market did initially open limit up, but then it started selling off. And Marcus, being the smart trader he is, he saw this as a major red flag. If the market couldn't sustain the rally on such positive news, it was a sign of, underlying weakness. So he gets out of his long position and even goes short, a move that turned out to be incredibly profitable.
Wow. So even in a seemingly obvious situation, the market's reaction or, lack thereof can provide valuable clues.
It's all about being attuned to those subtle signals.
Right, right. Any other examples of this?
One more that really highlights this concept. Stanley Druckenmiller, known for his bold trades, was heavily long the Deutschmark. News breaks that Saddam Hussein is going to surrender in the first Iraq War, an event that should have been bearish for the Deutschmark.
Okay, because a resolution to the war would likely weaken the dollar, and a weaker dollar usually means a stronger Deutschmark.
Exactly. But here's the thing. The market barely reacted to the news. Druckenmiller, being the savvy trader that he is, recognized this lack of movement as a sign that, well, his thesis was wrong.
So the absence of a move was actually a signal.
Mm-hmm.
That's incredible.
It was a huge wake-up call for him. He realized the market wasn't behaving as he expected, and he liquidated his entire position, avoiding potentially massive loss. These stories really underscore the importance of being a market detective, constantly looking for clues and interpreting them correctly.
It's like learning to read the market's body language.
Right.
Looking for those subtle tells that reveal its true intentions. So we've talked about discipline, risk management, adaptability, and now this fascinating concept of reading the market's whispers. Is there a secret ingredient that ties all of these principles together?
Well, Schwager suggests that the most successful traders have a distinct edge, something that gives them a consistent advantage in the market.
So it's not just about following a set of rules. It's about finding something that sets you apart from the crowd, right?
Precisely. It could be a unique understanding of a particular market, a proprietary trading system, or even just a knack for spotting patterns that others miss. But it's not really about having some secret formula. It's more about how these traders think, how they process information.
So are you saying it's about having a specific mental framework, a lens through which they view the markets?
Exactly. Some traders are pure fundamentalists, digging deep into economic trends and company valuations. Others are technical wizards, deciphering patterns in charts and price movements.
And some, like those quant guys we talked about earlier, are crunching numbers and building complex algorithms.
Right. The key is that they all have a framework for understanding the market, a way to filter the information and identify the opportunities that align with their edge.
So it's not just about being smart, it's about having a system, like a mental model, that helps you make sense of the chaos.
And this leads to another crucial element that Schwager emphasizes, independent thinking. It's not about blindly following the crowd or, chasing the latest hot tip. It's about having conviction in your own analysis, even when it goes against the grain.
So it's about trusting your own process, even when everyone else is telling you you're wrong.
Exactly. The market wizards are successful because they trust their own judgment, even when it's unpopular. They're willing to stand apart from the crowd and bet on their own convictions.
It takes a lot of courage to go against the herd, especially when the stakes are so high. But that brings up a question. Even with an edge and independent thinking, Trading is still a game of probabilities, right?
You're absolutely right. You can't win every trade. That's where the concept of expectancy comes in. It's not about being right or wrong on every single trade, but about the average outcome over time.
So it's like flipping a coin. If the coin is slightly weighted to land on heads 55% of the time, you'll still lose sometimes. But over many flips, you'll come out ahead.
That's a great way to put it. Successful traders have a positive expectancy. Their system, their edge, gives them a statistical advantage over time, even if they experience, individual losses along the way.
So patience is key. But the market is constantly changing. How do these traders adapt their edge to stay ahead of the curve?
Schwager highlights the importance of recognizing when your edge is eroding and being willing to adapt. Remember Edward Thorpe, the quant trader we discussed earlier?
Yeah.
He was constantly refining his approach as market conditions change, moving from, market neutral to sector neutral and finally to like factor neutral portfolio's.
So even with a proven edge, you can't just set it and forget it. You have to be a constant student of the market. Always testing, always refining.
Absolutely. And this leads to another fascinating aspect of trading that Schwager explores, position sizing.
You mean how much you bet on each trade? Isn't that just like basic risk management?
It's a little more nuanced than that. The market wizards often vary their position size based on their conviction level.
So if they're really confident in a trade, they bet bigger.
Exactly. They're essentially tilting the odds even further in their favor. But they also know when to scale back their size, especially when, things aren't working or when market volatility is high.
So it's about being dynamic, reading the market's feedback and adjusting your bet size accordingly.
It's another layer of strategy on top of like your entry and exit points. Schwager provides examples of both extremes. Paul Tudor Jones, in his early days, nearly blew up his account by over-leveraging a cotton trade.
That sounds risky.
It was. It was a valuable lesson for him about, respecting risk and sizing his bets appropriately. On the other hand, Stanley Druckenmiller was once encouraged by George Soros to, double down on a winning dollar Deutschmark trade, a move that turned out to be incredibly profitable.
So it's about having the courage of your convictions, but also the discipline to manage risk, knowing when to step on the gas or, hit the brakes.
Precisely. And sometimes the best move is to, do nothing at all. Schwager highlights the importance of patience, of waiting for the right setups, the high probability trades that fit your edge. He quotes a line from Edwin Lefebvre's classic book, Reminiscences of a Stock Operator. There is the plain fool who does the wrong thing at all times everywhere, but there is the Wall Street fool who thinks he must trade all the time.
So it's about resisting that urge to constantly be in the action and instead, being selective, waiting for the perfect pitch.
Exactly. He gives the example of Michael Marcus, who learned patience from Ed Seykota, a legendary systematic trader. Seykota would often hold on to positions for days or even weeks, patiently riding the trend.
So it's not about trying to time every peak and valley, but about capturing the meat of the move.
Right.
But how do you know when to hold on and when to take profits? That seems like the million-dollar question.
It is a delicate balance, and there's no one-size-fits-all answer. Your system, your risk management rules, and your emotional discipline all come into play. But Schweiger emphasizes that it's often better to err on the side of letting profits run rather than cutting them short prematurely.
So it's almost like fighting against human nature. We're wired to seek instant gratification, but trading success often requires delayed gratification.
That's a great point. It takes discipline and a willingness to trust the process. Now, let's move on to the final part of our deep dive, where we'll explore the psychological aspects of trading success, the mindset, emotional control, and the surprising role of intuition.
Let's do it. I'm ready to go deep on the mental game. We're back for the final leg of our deep dive into the little book of market wizards. We've covered strategies, discipline, risk management, the whole thing about reading those market whispers, right?
Right.
But now let's get into what might be the most crucial element of all the psychology of trading success.
Yeah, this is where it gets really interesting. Schwager, he really doesn't shy away from the mental game. He makes it clear trading, it's as much about mastering your emotions as it is about having a winning strategy.
Yeah, it's easy to say, stay calm, when the market's going your way.
Yeah.
But how do these market wizards actually maintain their composure when there are millions on the line and the pressure is just intense?
One of the key concepts that Schwager highlights is emotional detachment, that ability to kind of separate your ego from your trading decisions.
Emotional detachment. That sounds more like something you'd practice in a yoga class, not on Wall Street.
Think of it this way. The market, it doesn't care about your feelings, your hopes, your fears. It's a force of nature. It's driven by, countless factors, and you got to approach it with a certain level of objectivity.
So are we all striving to be like trading robots?
Mm-hmm.
No emotions allowed?
No, it's not about suppressing emotions completely. That's impossible. Probably unhealthy, too. It's about managing them, not letting them cloud your judgment or dictate your decisions. Schwager tells this story about a trader who was working with like a performance coach to try to overcome his emotional trading habits. The coach helped him, develop techniques for staying calm, staying detached, and initially it worked. The trader was profitable. He was following his system.
Sounds like he'd found the secret to like trading Zen.
Right. But here's the twist. After a while, he got bored. He was making money, but it wasn't exciting anymore. He missed the adrenaline rush, the highs and lows of impulsive trading, even though he knew it was ultimately like detrimental to his success.
Oh, wow. Yeah, I can see how that would happen.
Yeah.
Trading can be addictive, especially when you're chasing like those dopamine hits from big wins.
Exactly. It's a constant battle. You got to find a way to stay engaged and enjoy the process without getting swept away by the emotional roller coaster.
So emotional detachment is about kind of finding that balance, staying objective, but also staying motivated.
Exactly. And now let's delve into a concept that might surprise you, the role of intuition in trading success.
Intuition? You mean like gut feelings? I thought trading was all about logic, analysis,
Yeah.
and cold, hard data.
Yeah, well, the market wizards, they often describe like developing a sixth sense, an ability to kind of read the market's subtle cues and anticipate moves before they happen.
So like they have some kind of like spidey sense for trading,
Yeah.
tingling whenever there's like danger or opportunity.
It's more nuanced than that. It's an awareness that comes from years of experience, right?
Yeah.
Observing patterns, making mistakes, and learning from them. It's not some like random hunch. It's informed intuition built upon a deep understanding of the market.
That makes sense. It's like any skill, right? The more you practice, the more you develop a feel for it, an ability to sense things that might not be obvious to a novice.
Exactly, like learning a language. The more you immerse yourself in it, the more fluent you become.
Right.
And here's the crucial point. Intuition. It's not a replacement for analysis. It complements it. The market wizards use their intuition to kind of guide their research, refine their strategies, make those split-second decisions when the market is moving fast.
So it's about like integrating the logical and the intuitive, the left brain and the right brain kind of working together.
Exactly. And this leads to another important concept Schwager discusses, the importance of having a trading philosophy.
A trading philosophy, that sounds pretty deep. What does that even mean?
It's about defining your values as a trader, your risk tolerance, your approach to the market, what you're ultimately trying to achieve. It's about answering the question, why do I trade?
So it's not just about, making money.
It can be, of course, but for the market wizards, it's often about more than that. It's about the challenge, the intellectual stimulation, the pursuit of mastery. They're driven by a desire to understand this complex and ever-changing beast we call the market.
It sounds like they found a way to align their passion with their profession.
And that's, I think, a key ingredient for long-term success in trading or any other field, really.
So where does this leave us? We've covered a lot of ground in this deep dive, from like the nuts and bolts of trading strategy to the psychology of these market masters. What's the final message, the ultimate takeaway for aspiring traders?
Schwager doesn't offer a magic formula or a set of, rigid rules. Instead, he provides a framework for thinking about the market, for developing your own unique approach, your own edge, your own trading philosophy.
It's about finding your own path to market mastery. A path that aligns with your personality, your strengths, your values.
And perhaps most importantly, it's about embracing the journey itself, the ups and downs, the wins and losses, the constant learning and adaptation. That's what makes trading such a challenging and rewarding pursuit.
It's been a fascinating journey exploring the minds of market wizards. You've given our listeners a lot to think about.
It's been my pleasure.
Thanks for joining us on the Deep Dive. We'll catch you next time as we continue to explore the endless depths of knowledge and ideas.